My fellow FIers, welcome back to another episode of Retirement Police Most Wanted. So happy to have you join us today, and we appreciate you taking the time to watch or listen to us. If you haven't already, hit subscribe, tell others who are like-minded, or tell others that you think would benefit from learning more about FI and how that's possible in their life. So, very excited. We are in March, and when I think of March, I think of many things. Certainly, St. Patrick's Day comes to mind. McDonald's Shamrock Shakes. I'm not giving a plug for McDonald's. Those are things that I think about. But then, you cannot help but think of March Madness. And March Madness also means bracketology. I know there's a lot of sports fans out there, myself included, but today the type of brackets that we are talking about do not actually have to do with sports unless you consider taxes a sporting event. And some of us actually do. And the way to keep going beyond to get past each round is if you can succeed in this. Now, full disclosure, full disclaimer, this is a show that is purely for entertainment only. This is not financial advice, life advice, tax advice. It is none of those things. Personal finance is personal. You should be consulting your personal attorneys, your accountants, your life coach, your spiritual coach, any experts that you need to understand your personal situation before you make decisions. But we do think that it is important to think about, while we like to have parts of this be evergreen, we are in a moment in time where we have something known as the 2017 Tax Cut and Jobs Act. It will expire at the end of 2025. If Congress does not take action. And I really want to set the stage for that. I want to go back in the time machine here. And for some of you, maybe you're the teens, and I hope you're in your teens, or I hope you're in your college years, or your 20-something years that you're following this journey along. It's never too late to start. Starting early in the FI journey has great benefits. It's a way to help you become a true HouFIni. And by that, we certainly mean, I like to think of myself as HouFIni after the great Harry Houdini, great escapologist, was able to break the chains. Harry handcuff Houdini would always get out of a variety of difficult situations and didn't like to reveal the mystery behind his tricks. But here at Retirement Police Most Wanted, we want to share those tricks with you. Again, just for your own consideration, for your entertainment value. So HouFIni is H-O-U, FI, and the FI is financial independence. The NI, not an illusion, is not an illusion here. That's what we are emphasizing, HouFIni. So, getting back to the aspect of the 2017 Tax Cut and Jobs Act, why is that important? Going back in the time machine, and we'll put these up, some visuals up here. If we look at the singles bracket, and I want to focus on that for a moment. Let's focus on the singles bracket. Going back, if you were comparing the 2017 tax brackets to the 2018 tax brackets for singles, you had in 2017 at a 10% tax rate that covered $0 to $935. If you looked at the 2018 year, There was also a 10% tax bracket, and that covered $0 to $9,525. Then we go to 2017, and there was a 15% tax bracket was the next tax bracket, and that was $9,325 to $37,950. In 2018, the next bracket above the 10% bracket was 12%, and that was part of the modification in brackets, and that covered $9,525 to $38,700. So you were already in a lesser 3% less taxes in what was roughly the equivalent dollar amount. In 2017, the next tax bracket above the 15% tax bracket was 25%. So a big leap, a 10% increase, and that covered $37,950 to $91,900. And again, this is for a single tax filer. When we got to 2018, that 25% tax bracket, that was not there. In 2018, you went from 12% tax bracket to a 22% tax bracket. Again, another 10% tax percent increase. This covered $38,700 to $82,500. So slightly less than what the 25% tax bracket covered in the previous year of 2017. Flipping back again to 2017, above the 25% tax bracket was a 28% tax bracket, and at the time it covered $91,900 to $191,650. If you flip to the next year for that single bracket in 2018, above the 22% bracket is a 24% bracket, and that covered $82,500 to $157,500. Going back to the 2017 tax year, there was a 33% tax bracket, up from 28%, and that covered $191,650 to $416,700. So a very huge tax bracket there in that 33% range. You flip to the next year, 2018, going from the 24% tax bracket, leaping up to a 32% tax bracket for singles. That covered $157,500 to $200,000. So slightly less taxes, but a lower threshold there. You go to 2017, the 35% tax bracket was above the 33% tax bracket, and that covered $416,700 to $418,400. So a very narrow window there of income. Whereas the 2018 year on the single side, the 35% tax bracket, if you were fortunate enough to be in it as a single person, was $200,000 to $500,000. So a big, wide open gap there. Much of it slightly above the 2017 33% rate. Going back, the final bracket in 2017 was 39.6%, and for singles, that was anything over $418,000. And in 2018, it was 37%, and that was anything over $500,000. So I'm sure you're saying to yourself, why are you mentioning this? I just want to help you understand the difference the collapsing of the tax brackets, particularly on the lower end, the 10%, the 12%, the 22%, even the 24% tax brackets. You know, just for sake of review, because we really focus on family fi here, and that would tend to be your married filing jointly couples. If you go back to see what kind of those brackets were from 2017 to 2018, we'll run through the numbers again. In 2017, and I just want to note that the standard deduction in 2017 for married filing jointly was $12,700. And if you had that, you would itemize deductions. We can get into that a little bit more. But when you looked at, in 2017, married filing jointly, 10% tax bracket covered those with income from $0 to $18,650, versus in 2018, you had essentially almost a doubling of the standard deduction. In 2017, that standard deduction was $12,700. By 2018, the standard deduction went to $24,000, and the 10% tax bracket was from $0 to $19,050 in 2018. Then we flip back to 2017, and at 15%, it was $18,650 all the way up to $75,900. Going to 2018, instead of a 15% tax bracket, now I have a 12% tax bracket, and that was $19,050 to $77,400. Going to 2017, the next tax bracket above 15%, same as the singles, went up 10% to 25%. The range for the married filing jointly was $75,900 to $153,100. On the flip side, you go to 2018, the next largest bracket above 12% was 22%, and it was $77,400 to $165,000. That is really sort of this sweet spot for married couples filing jointly. 12% bracket, the 22% bracket, and this next one we're going to get to. When you look at 2017, above the 25% bracket was a 28% bracket, and that covered $153,100 to $233,350. And then going to 2018, the 24% tax bracket, so slightly above that 22% bracket, goes from $165,500 to $315,000. I'm going to quickly keep going through this. 2017, up from the 25% bracket, the 28% bracket for married filing jointly was $153,100 to $233,350. Flip to 2018, the 32% bracket was $315,000 to $400,000, versus in 2017 you had a 33% tax bracket, which was $233,350 to $416,700. In 2017, you also had a 35% tax bracket that went from $416,700 to $470,700. On the flip side, in 2018, your married filing jointly 35% tax bracket was $400,000 to $600,000. In 2017, your highest tax bracket was 39.6%, and that was for married filing jointly making over $470,700. And in 2018, your highest tax bracket was $37,000, and that was for married filing jointly over $600,000. So Why am I babbling all about 2017 and 2018? Why did I run through those? I wanted to give you what was the close comparison between how those tax brackets adjusted between those 2 years. I also want to set the stage for there are some estimates that 62% of tax filers would experience a tax increase if the Tax Cut and Jobs Act expires at the end of 2025. So you're saying to yourself, HouFIni, it's March. I'm in the middle of trying to file my taxes, or I've already filed my taxes. What does this have to do with anything? I do hear on the news, or I have read things about Congress trying to do a tax bill, and I can't make heads or tails of it, and it seems like it's going to go real fast, or it seems like some people don't think it's going to go fast. We don't know. What does this mean? My point is that at some point, I do believe that there's going to be a tax bill, and I think there would have been a tax bill no matter who was controlling Congress in 2025, no matter who was going to be the president in 2025. With the 2017 Tax Cut and Jobs Act, those temporary tax brackets and provisions being in place, expiring, people were going to have to deal with this. And so today, if you've already filed your taxes for 2024, you may have already done that, or you have until April to do with that. And you're like, this is March Madness. I just want to watch basketball. I just want to have fun. I don't want to think about any of this. HouFIni understands. But HouFIni also says you want to be thinking proactively about things. Let's just run through what we already know the IRS has revealed are the 2025 tax brackets. And this is for due in April of 2026. Based on what we know today, and one other thing to note, Congress in 2017, they did not come to a tax bill until the very end of December in 2017. What the IRS revealed as the tax brackets, as we know them today in March 2025. The other thing that I should say, the major difference from 2017 to today is 90% of the people, and don't quote me the exact, around 90% of tax filers just use the standard deduction now. They no longer itemize. There's multiple reasons for it, but most people itemize. So single filers, the standard deduction for 2025 is $15,000. Talk about that a little bit more. But what we know is the 10% tax bracket, assuming nothing changes, would be $0 to $11,925. The 12% tax bracket would be $11,926 to $48,475. The 22% tax bracket would be $48,476 to $103,350. The 24% tax bracket would be $103,351 to $197,300. Then going up to the 32% tax bracket, it would be $197,301 to $250,525. Again, this is all for persons that are categorized as single, and if you're making that kind of money, that's amazing. The 35% tax bracket is $250,526 to $626,350, and then 37% tax bracket would be if your adjusted gross income is $626,351 or more. And again, you get the $15,000 standard deduction. Why do I mention that? You sort of have this sweet spot of being able to work with an extra $15,000 worth of income. What do I mean by that? Actually, let me step back. It was a long time before I understood. People will say to me, I pay 24% taxes. That's what I pay. You're not paying 24% of taxes for everything. No, I pay 24% of taxes. You gotta understand, if you don't already, and believe me, I'm not being judgmental about this because it took me a long time to understand this. You pay 10% tax as a single person on anything below $11,925. Then if you are in the 12% tax bracket, so anything above that $11,926, you have a 12% tax rate, and that goes up to $48,475 as a single person. If you're fortunate enough, even with the standard deduction, to have income beyond that, then anything above that 12% tax rate, you're going to be paying a 22% tax rate for anything between $48,476 to $103,350. Above $103,351, you'd be paying 24% tax, and so on and so forth. But let me give you an example. Let's say you are earning $60,000 a year as a single person. Well, you're thinking, okay, I'd be in the 22% tax bracket, but when you minus the $15,000 standard deduction, you are going to 60,000 minus 15,000 puts you at 45,000. So instead of being in that 22% tax bracket, you will be in the 12% tax bracket, assuming you have no other sources of income. So you have that $45,000. Now, let's say you are single and you make $80,000 a year, and you're like, okay, I make $80,000 a year. I'm in the 22% tax bracket. I take $15,000 for the standard deduction, so I'm at $65,000, but I'm still in that 22% tax bracket. So I'm at the max level of the 12% tax bracket at $48,475. And so then I'm paying 22% on everything over and above $48,476. So let's say you have the ability to max out your 401k or a 403b, or if you have access to the pre-tax accounts in terms of a pre-tax 401k or 403b, you could max it out, and the maximum contribution in 2025 is $23,000 a year. If you're under the age of 50, there is an additional $7,500 catch-up contribution if you're over the age 50. But let's say you're under age 50, and so you're able to max out that $23,000. So you had $80,000 as your income, no other sources of income. $15,000 standard deduction brings your income down to $65,000. You're able to max out that $23,000 in pre-tax income. So $65,000 minus $23,000 brings you down to $42,000. And boom, you're in that 12% tax bracket entirely. That creates an interesting situation, and you're allowing those dollars to grow in your 401k or your 403b, let's say. And when you pull them out of your retirement accounts at age 59 and a half, and there's ways to do that sooner, but let's, for the sake of argument, because we also have the blog at fi59.5.com, which is when most people would be first eligible to remove those funds from their pre-tax accounts. Then you remove those funds then, and then you're taxed on it. Now, we don't know what those tax rates are going to be. Someone may say, you know what, I'm okay. I also have access to an employer Roth 401k or a Roth 403b. So I'm making that $80,000 a year as a single person. I have no other income. I take that standard deduction to $15,000, and I'm down at $65,000 worth of income. So I am in that 22% tax bracket, but I'm on the lower end of that 22% tax bracket. And I'm going to pay the tax and do the max in the Roth. And the beauty of the Roth is I pay those taxes now. I know what those taxes are, and I am going to assume that the time that I access that money and I don't have to pay taxes on the growth, all of that growth in my retirement account is tax-free. I'm going to go for that. There are people that I know that really feel stuck now that they have all of this money in their pre-tax retirement account. They thought they were doing an amazing job, and they were. We are so heavily invested in this same situation because Roth wasn't really a thing when we first started investing. It was questions about it. A lot of the tax professionals argued against it. It probably would have been a much better thing for us to invest in that in our younger years when we were in a lower tax bracket. And then as we started to earn higher income, switch to pre-tax retirement accounts if we were prepared to do that, to lower our income, to modify and make these adjustments in the bracketology. This is why this is March Madness. This is why it is so important to pay attention to the magic of bracketology. So thanks again for being with us on another episode of Retirement Police Most Wanted. Please hit subscribe and continue to follow us. We are continuing to hone our craft here on Retirement Police Most Wanted as we are in our 100-month journey to financial independence, and we want to go on the lam from the retirement police, break those golden handcuffs. We wish you all the very best in your March Madness bracketology pursuits. We hope that you don't hit any bracket busters, that your teams win, that you find Cinderella once again this March leading into April. We'll be here. We'll be doing more bracketology for you. And it's not basketball bracketology, it's tax bracketology. It's that tax March Madness that we're looking forward to here. As always, we part with our disclaimer to remind you that the content on this video, our website, check us out over at 59.5.com, podcast, any blog posts are not intended to be investment or life advice. Readers should consult with their legal, financial, and accounting specialists and spiritual and or life coaches to provide insight on their personal and specific circumstances, as each situation is unique. That's right. Personal finance is personal. The videos, website, podcast, and any blog posts are written for and produced for entertainment purposes only. So, my fellow FIers, will see you on our next episode of this journey. Take care and have a good March Madness.